Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson Types of Economic Policies. Economic policies are fundamental tools that governments use to influence a nation's economy. These policies are designed to achieve specific economic objectives, such as controlling inflation, reducing unemployment, fostering economic growth, and ensuring a fair distribution of wealth. Understanding the types of economic policies is crucial for anyone studying public policy economics, as it provides insight into how governments can shape economic outcomes and address various economic challenges. At the core of economic policy are two primary categories: fiscal policy and monetary policy. Fiscal policy refers to the use of government spending and taxation to influence the economy. Governments can implement expansionary fiscal policies by increasing public spending or decreasing taxes to stimulate economic growth, particularly during periods of recession. Conversely, contractionary fiscal policies involve reducing public spending or increasing taxes to cool down an overheated economy and control inflation. For example, the American Recovery and Reinvestment Act of 2009 was an expansionary fiscal policy aimed at mitigating the effects of the Great Recession by injecting approximately $831 billion into the economy through various public projects and tax incentives. Monetary policy, on the other hand, involves the management of the money supply and interest rates by a nation's central bank. The primary goal of monetary policy is to control inflation and stabilize the currency. Central banks can adopt expansionary monetary policies by lowering interest rates and increasing the money supply to encourage borrowing and investment. For instance, during the 2008 financial crisis, the Federal Reserve significantly lowered interest rates and implemented quantitative easing to provide liquidity to the financial system. In contrast, contractionary monetary policies are used to curb inflation by raising interest rates and reducing the money supply. Pause. Beyond fiscal and monetary policies, trade policy is another significant economic policy tool. Trade policy encompasses the regulations and agreements that countries use to govern international trade. Governments can adopt protectionist measures, such as tariffs and quotas, to shield domestic industries from foreign competition. For example, the Smoot-Hawley Tariff Act of 1930 imposed high tariffs on imported goods to protect American businesses during the Great Depression, although it ultimately exacerbated the economic downturn by reducing international trade. Alternatively, governments can pursue free trade policies that reduce barriers to international trade, promoting economic efficiency and consumer choice. The North American Free Trade Agreement, implemented in 1994, is an example of a free trade agreement that aimed to eliminate tariffs and other trade barriers between the United States, Canada, and Mexico, fostering economic integration and growth among the member countries. Another essential aspect of economic policy is regulatory policy, which involves the establishment of rules and standards to govern economic activities. Regulatory policies are designed to protect consumers, workers, and the environment, as well as to ensure fair competition in the marketplace. For instance, the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 was enacted to address the regulatory failures that contributed to the 2008 financial crisis. This comprehensive legislation introduced significant changes to financial regulation, including the creation of the Consumer Financial Protection Bureau to oversee consumer protection in the financial sector. Social policy is another critical component of economic policy, aimed at promoting social welfare and addressing issues such as poverty, inequality, and access to essential services. Social policies often involve public spending on healthcare, education, social security, and housing. For example, the Social Security Act of 1935 established a social insurance program in the United States to provide financial support to the elderly, the unemployed, and the disabled, thereby reducing poverty and economic insecurity. Similarly, the Affordable Care Act of 2010 sought to expand access to healthcare and reduce the number of uninsured Americans through subsidies, mandates, and the expansion of Medicaid. In addition to these core types of economic policies, governments also use industrial policy to support specific sectors of the economy. Industrial policy involves targeted interventions to promote the growth and development of particular industries, often through subsidies, tax incentives, and research and development support. For instance, the semiconductor industry in the United States has benefited from government support through initiatives such as the Semiconductor Manufacturing Technology Consortium, which aim to enhance the competitiveness of the American semiconductor industry. Environmental policy is another important area of economic policy that seeks to address environmental challenges such as climate change, pollution, and resource depletion. Governments can implement a range of measures, including regulations, taxes, and market-based instruments like cap-and-trade systems, to reduce environmental impacts and promote sustainable development. The European Union's emissions trading system, established in 2005, is a notable example of a market-based approach to reducing greenhouse gas emissions by setting a cap on emissions and allowing companies to trade emission allowances. In practice, the effectiveness of economic policies depends on various factors, including the context in which they are implemented, the specific design of the policies, and the capacity of governments to enforce them. For instance, while expansionary fiscal and monetary policies can be effective in stimulating economic growth during a recession, their success may be limited by factors such as high levels of public debt or structural issues in the economy. Similarly, trade policies that promote free trade can lead to economic growth and consumer benefits, but they may also result in job losses and economic dislocation in certain industries, necessitating complementary policies to support affected workers and communities. The interaction between different types of economic policies also plays a crucial role in shaping economic outcomes. For example, fiscal and monetary policies often need to be coordinated to achieve macroeconomic stability. During the 2008 financial crisis, the combination of expansionary fiscal policies, such as the American Recovery and Reinvestment Act, and expansionary monetary policies, such as the Federal Reserve's quantitative easing, helped to stabilize the economy and support recovery. Similarly, regulatory and industrial policies can complement each other by ensuring that targeted support for specific industries is accompanied by appropriate regulatory oversight to prevent market distortions and protect public interests. In conclusion, understanding the various types of economic policies and their applications is essential for analyzing how governments can influence economic outcomes and address different economic challenges. Fiscal and monetary policies are fundamental tools for managing economic cycles and ensuring macroeconomic stability. Trade policy shapes international economic relations and impacts domestic industries. Regulatory policy safeguards consumers, workers, and the environment while ensuring fair competition. Social policy addresses issues of welfare and equity, while industrial policy supports the growth of specific sectors. Environmental policy tackles pressing environmental issues and promotes sustainability. The effectiveness of these policies depends on their design, implementation, and coordination, as well as the broader economic context in which they operate. By studying these policies, students of public policy economics can gain a comprehensive understanding of the government's role in managing the economy and promoting societal well-being. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.